Joining me now is Simeon Gutman, retail analyst at Morgan Stanley. And Simeon, of course, I want to ask you about so many broader cross currents here, but maybe Five Below is a good example of a retailer that can actually beat expectations in this environment.
Yeah, I think I'd call it better than feared. If you take the roller coaster we've been on since late January to now early March and how the consumer has been behaving, we went from consumers fine to something's not right, weather, storms, tariff fears. Is the consumer underlying getting worse? Now we're sort of at the culmination of earnings season, and we got relief that this business, Five Below, which, is going through a transition. I don't know if you'd call it turnaround. Their top line is decent, and they have an outlook to grow this year. So to me, that was the message of the quarter, is that the consumer is actually hanging in a little bit better than some of the fears that were building up over the last month.
Do you attribute those fears to us jumping to conclusions? Or when you read, as I do, the comments from Delta's CEO or even what Walmart said, do you think, well, that's worth paying attention to?
Everything's worth paying attention to. But if you take the facts, the numbers, is a consumer's willingness to spend has changed, but their ability really hasn't. So they're feeling less good. And I think that's what Walmart's CEO is referring to, is the yellow flags that the consumer's getting more concerned. Look, post-inauguration, there's fears about what tariffs do to their spending power. That's the fear. They're still spending. If you look at what PCE, personal consumption expenditures, are growing, they're growing just about where they should. It's where they're growing, services over goods, and where they're growing within goods. A lot of it is the non-durable stuff, and eventually that'll come back. But the underlying run rate of spend hasn't really changed much.
So that would be firmly in the camp of Michelle Meyer, Ted Rossman, those who are telling us their capability is not changing yet. Their willingness is changing. And I guess then going forward, it just depends on what, if we can get certainty on tariffs. It just seems like a long thing to connect that to what people are doing at, Five Below or Dick's Sporting Goods or Best Buy or what have you.
Yeah, I mean, at the top of the real spending is durable goods, and a lot of it is the cascading effect that housing can have. And remember, we entered last year expecting and hoping interest rates to get cut. That is typically the beginning of a cycle. We haven't gotten there yet, right? Interest rates only went up, mortgage rates went higher. It looks like durable goods has completely normalized. It's reverted. It's given everything back that we overconsumed during COVID. So we're actually at the bottom, and we're at a rate in which we can start to see some growth. But if we buy a home, then our saving decisions changes, and then we start buying other durable goods, and that creates that cascading effect. You mentioned Best Buy. It would, of course, be in the home improvement realm. Sporting goods, that's been a good category in general. That's been okay. That's one of the secular winners of this entire episode that we've been through. But a lot of things will get triggered with housing.
Right, and there were so many glimmers from Home Depot and Lowe's when those started to report, and you think, hey, positive comps for the first time in 2 years or whatever the number was, maybe we're starting that cascading process, but maybe now it's been delayed somewhat. So you had a more granular sort of report on Walmart, and specifically, this was surprising to you. You said, hey, its e-commerce business is about to be profitable. Well, I thought it already was. So, they've been building out, they've been taking margin, whatever you want to say, to build this out. It's become quite successful. And now is a moment that they can reap the benefits, it sounds like.
Yeah. So to be fair, look, the stock has been appreciating. The multiple's been going up for the last year or so. So the market sensed that this moment was happening. But for all of us who follow Walmart over its lifetime, especially the last decade, this is a watershed moment. Granted, there's a lot of definitions of e-commerce profitability. I think people understand that, how costs are getting allocated. Walmart's relatively conservative in how they look at it, and they don't disclose this. This is our math. This is our estimate. But it looks like they're turning the corner. And the most important point of that is leveraging these fixed investments, and the next 3 years, it converts into $6 billion of incremental profits. And on a base of, call it $30 billion, that's pretty significant. That's 20% just from e-commerce crossing that threshold, the point at which they've put enough investment in the ground and the incremental sales are finally converting to new profit. That's a big moment, and that's confidence building for the durability of their outlook.